few items. Good afternoon, and welcome to Assembly members and also to officers here at City Hall, and to members of the public who are here, and also anyone who's watching on the webcast, to today's meeting on the 13th of October of the London Assembly's Oversight Committee. Can I just remind everyone to put their phones on silent, and if by silent that also includes vibrate, can you not put it in front of your microphone, because that can still be picked up. I just wondered if I could ask the clerk if we have received any apologies for absence.
Thank you, Chair. We've had apologies for absence from Assemblymember Ahmed.
Thank you. Item 2 on the agenda is declaration of interests. Can we note the list of offices held by Assembly members? Is that noted? Now, normally when we get to the disclosing whether anyone has any further disclosable pecuniary interests in specific items listed on the agenda, I think probably quite a few of us might need to make a disclosable pecuniary interest in the matter relating to pensions, because quite a few of us will be within the pension scheme. I'm not sure that the discussion has a pecuniary aspect to it in terms of the outcome of the item, but just for transparency, I think we should note that Assembly members are included in one of the very many pension schemes that we will be discussing later. If that's satisfactory, thank you. Minutes of the previous meeting, which are found on pages 5 to 16 of your agenda pack. Can I see if everyone is happy to confirm the minutes as a true record? Okay. That means I will be able to... in fact, actually, there's two lots of minutes. We have the 16th of June and we also have the 13th of July. Yep, thank you. Item 4 is the summary list of actions, which are to be found on pages 17 to 42 of your agenda pack. Can we note the completed and ongoing actions which have arisen from previous meetings of the Oversight Committee and the additional correspondence sent and received? Is that noted? Okay. Action taken under delegated authority, item 5. We have a number of items that I just need to draw to your attention. The first of these, which I think Assemblymember Pigeon knows rather a lot about, the Oversight Committee's report GLA Procurement came out but has been circulated to you as Appendix 1. We also sent a letter to the Mayor regarding the anniversary of the expulsion of Asians from Uganda, which is attached as Appendix 2. And the Oversight Committee's report on governance of trade missions and the GLA Code of Conduct is attached as Appendix 3. So can we note all of those actions which have been taken? Thank you. Can I also ask you to note the recent action which was taken by the Chair of the Assembly under delegated authority to agree, in consultation with Deputy Chairman of the London Assembly and the party group leads, which was to agree the content of our annual report, which has now been issued. Is that agreed? Thank you. And that is Appendix 4. Item number 6 on the agenda is the Mayor's response to outputs, and that's to be found at pages 49 to 62. And I can see that Assemblymember Pigeon has indicated that she would like to say something.
Yeah, I just wanted to draw members' attention to the response we've had from the Mayor of London to our detailed letter about the relocation of City Hall, and to express my concern, I'm sure all of our concern, that the Mayor is still disputing our figures around the true savings that actually materialise out of this move, and that he was going to stick to his original assertion that it's 61 million when actually it was, I think, 37 million that we uncovered. So I think I would like officers of the GLA to use the correct figure, which is 37 million. We can't instruct the Mayor on what he should do, but I think we should put on record our concern that the Mayor is still insisting on sticking to a figure that we've proven is not accurate.
Yes, and the difference between the two is the original rental cost to the GLA of remaining in the old City Hall, and the revised cost, which came down because the owners of the building agreed to negotiate and reduce their rent demand. and so spreading that over the 5 years period that's being used as the reference point. Is everybody minded to agree that the point that Assemblymember Pigeon has raised, that we should be using that figure? Okay, I think that's achieved unanimity. Any further points on the Mayor's response to outputs that anyone wants to raise? Okay, we move on to item 7, which is the Greater London Returning Officer's response to the Election Review Working Group's report on the 2021 Mayor and London Assembly elections. Can I see any indications of any points that anyone wants to raise on agenda item 7? And I can see Assemblymember Russell.
Thank you very much.
Microphone.
Incapable of operating a microphone. The issue of design of the ballot paper, even though the election process has been changed, so one of the main problems with the design of the last ballot paper won't apply, it's still really important that those recommendations about design of the ballot paper are still followed through on.
So I think we need to note that as something for us to take forward and to make sure that goes into our list of actions that we will follow through on.
That would be great. Thank you very much.
Okay, if everyone's happy with that. Great. Any further matters that anyone wants to raise from that agenda item, number 7? If not, you'll be pleased to know that we've just got to agenda item number 8, which is entitled GLA Group Pensions. And at this point, I'd very much like to welcome what actually has turned out to be quite a large number of guests. Thank you very much for agreeing to join us this afternoon. We have quite a number of questions that we're going to put to you. We're relatively pressed for time, and I'm just going to say this to you, and I've been saying it to my colleagues, so if you can be relatively brief, and if there's a lot of detail, you can send that to us afterwards, because we're keen that we're not here until 7 p.m. tonight, because we have some other reports after we're talking to you. But we also want to maximise, obviously, talking to you about these really important issues. So if I may, I'd like to introduce our guests. First, on the left of the set of seats, is I'm not saying anything about politics left and right here, is Robert Branagh, who is the Chief Executive Officer of the London Pension Fund Authority. You're very welcome, and thank you for joining us. We also have Peter Ballard, who is the Funding and Risk Director, also from the London Pension Fund Authority. We have Patrick, who is the Statutory Group Finance Director from TfL. We then have Luke Webster, who's been with us actually quite recently, in the recent past, who's the Assistant Director, Group Treasury, and also the Chief Investment Officer for the GLA Group. And then finally we have Tim Handley, who's the Head of Pensions at TfL, and Padmesh Shukla, who is the Chief Investment Officer at TfL. So you're all very, very welcome. And I think we're going to try and put questions to specific individuals. If you feel a burning need to come in on and answer a question that we've put to somebody else, then if you want to briefly amplify their answer, that would be helpful. But we are probably not going to have time to put one question that all of you answer, just because, as I said, we don't want to be here until 7. So the first questions are going to be, as is tradition from me as the chair, and I want to start with Peter Ballard and Robert Branagh, and I want to ask about investment performance, and will the current economic and currency issues affecting the situation that we're in at the moment, is this likely to affect our performance? Obviously pensions has been talked about a lot in the current situation of I think turbulence is the word that's been applied to it. And does this matter, or is this just a sort of short-term turbulence, and this is the kind of thing that you would expect long-term investment, medium-term investment to take in its stride?
Thank you. So I think the first thing to say is I can't say that it has no impact. Of course, I wouldn't be in a position to say that. What I would say is that, as you suggested towards the end of your question, we're a very long-term investor, and what we're looking over short periods of time is not something that we would usually focus on. The recent headlines around pension funds becoming insolvent, etc., are related to a particular type of investment, liability-driven investments that we don't hold any of, and so we weren't affected by the extreme events that pension funds were particularly affected by from the recent market volatility. The currency movements and other movements in asset values we obviously are exposed to some extent, but the immediate effect was actually to raise our asset value slightly due to our overseas investments denominated in other currencies, so that the weakness of the pound had some positive impact, and that's exactly why we have put in place that approach of denominating in lots of different currencies. So short answer, not a large impact, but I couldn't say that there's no impact.
Okay, thank you. I think that's very clear. The London Pension Fund Authority investment return target is to achieve CPI plus 3.6%, Consumer Price Index plus 3.6% per annum. How did you arrive at that specific target? For example, is that the sort of minimum return that you're required to meet current and future liabilities, or is this derived through some other mechanism?
No, so that return target is set as a realistic best estimate over the very long term of what we think, based on our broad asset strategy, that we might be looking to achieve. It was based on advice from investment advisors and also from LPPI, our delegated investment manager. And it's not about a minimum. It's more of a statement of intent to say that CPI plus 3.6% is a target that we would like to achieve, and we think we've got a 50-50 chance of achieving over the very long term.
Okay, I'm tempted to want to ask you more about the 50-50 chance, but I just want to see if Assembly Member Fortune wants to come in at this point.
Thank you. Just very quickly about investments. With the LCIV, the LPPI and Lpfa coming together to work with the London Fund, and the principal purpose of that was to help with housing infrastructure, affordable housing, etc. How's that performing?
I don't have any figures. I would have to come back to you on that. What I would say is that it's in its very early stages. We've got £150 million committed to that fund, of which only about 20 million has been drawn down at this point. So there are now, I think, 3 individual investments in that fund, but they really are at the very early stages of it.
Of those 3 investment vehicles, are any of them connected to housing delivery?
Yes, 2 of them are.
Okay.
So that I can give some details, but
I wouldn't
anything more
expect you
detailed, I'll be able to come back to you.
I wouldn't expect you to get down to starts. What I was looking for was just cross-referencing what the London Fund was delivering against housing figures, and whether or not the starts that were produced as a result of the London Fund were included in the Merrill's housing figures.
I wouldn't be able to. No, there won't be.
There's no double accounting. Thank you. Thanks.
Okay. I'm going to move on from Assembly Member Fortune to Assembly Member Pigeon, who's going to ask some questions about risk management.
Thank you very much. Could I just perhaps pick up with you, Peter, maybe Padmesh before that looking at our briefing and trying to understand the world of pension funds, which you obviously live day in, day out. Performance from your investment portfolio seems to have been maybe erratic in the last few years. So up 8% one year, drop back another, 16.8% the year after. Is this just purely COVID related? Is this normal? Is this just markets? What does it actually mean? And does this make it difficult for future planning? I'm going to start with Peter and then Padmesh.
Yeah. There have been ups and downs in the last few years. I'm probably not best placed to go into all of the reasons looking backwards for sort of the reasons for that. What I would say is that it's not especially unusual to have degrees of high investment returns followed by lower investment returns or negative investment returns in subsequent years. We very deliberately and kind of unashamedly are following an investment strategy that is intended to sort of optimise risk-adjusted returns over long periods. We are looking for return-seeking assets, and with those return-seeking assets comes volatility. As a pension fund and as a very long-term investor, we're not necessarily especially bothered by that large degree of volatility. We consider risk, and when we do monitor risk, and we're very mindful of risk, but when we're looking at it, we're thinking about it in terms of long-term ability to pay pensions over 50 plus years, and around the volatility of contributions that would be required from the employers that pay into our fund. So we're very mindful of that, and we are less concerned about daily or quarterly or even yearly fluctuations in asset values.
Okay, Padmesh, you want to comment on that, please?
Yes, I think very similar kind of the story there, because again, very focused on long term. And if you think of, historically, and even as we sort of speak today, if I look at our portfolio, roughly about 40% or thereabout is in equities. That's what we call as a kind of the growth asset, typically higher return, and with higher return comes higher risk. And it's the equity element of the portfolio that results in, the wobbling that you see. Sometimes the fund is up, sometimes the fund is down. And, we have and I think we're doing it with a kind of fairly open mind. It's not that we are unaware that there will be these short-term volatility movements, but then I think that's the balance we have to strike in terms of how much risk we take and are we being compensated to sort of take that risk. And I think just to set the scene there, I think what you see happening in the pensions market, this whole move of de-risking, that we don't want to take any risk, and it's precisely because they're trying to avoid this the short-term volatility. But then, as we have seen, that there's no such thing as no risk. And I think the question is, the risk you're taking, are you being compensated to take that risk? And that's the view we take when we think for long-term.
And are you satisfied with the management of risks associated with your investments? Have you got proper processes in place? Are you satisfied with that?
Absolutely. I think, I think risk is, I mean, I'll probably say, you learn. I mean, and obviously there is a fair bit of kind of precedence and template. I mean, we run some very complex models, but we have to just make sure that we're not completely reliant on these complex mathematical models. In the end, we live in real world, where we're just balancing these very quant-driven models with the real view of the world. So we try to marry the two. And obviously, we work with our investment advisors, and we focus on all kinds of metrics. And I think we are fairly comfortable that the risk we are taking, we understand, because that's the key thing. I mean, trustees need to understand what risk they're taking. And one of the things that we have done as a fund to maximize, what we call as, getting most bang for the buck is actually diversify. So we, at one stage, I remember like 10 years ago, possibly, our fund was close to about 70% in equities. We're down to 40. We are scaling it back further. And we are increasingly into other asset classes. And our experience in last 12 months, and actually year to date, has been actually quite positive. And if you look at the classic benchmark, which is down 20%, actually our fund is holding up very well. So, good news both on the risk management and diversification.
That's really interesting. And if I was to come and look at your risk register, what are the sort of top, say, 3 items on that, and what are you doing to mitigate those risks?
I mean, if you look at our sort of the risk register, I mean, clearly, I think I can sort of comment on the investment side. Obviously, there's a whole series of items on the operational side, which I think Tim probably is better placed to sort of comment. But I think on the sort of the investment side, clearly, I think we are focused on big ticket items like the interest rate risk, inflation risk, liquidity risk. I mean, that's because, as you can imagine, I think what's proven in last sort of couple of months is people have taken liquidity for given, which clearly has come back to sting many. So I think we are absolutely focused on the liquidity risk element. So if you ask me, and then increasingly, I think I think we have to be quite mindful of the IT risk, because clearly, as we know, the cyber threats, etc. I think we are quite focused on sort of that element as well.
That's very helpful. Let me come to Peter and ask you the same about your risk management associated with your investments, and what are your top items on your risk register?
And referring to the risk register there, you're thinking solely limited to investments or across the whole pension fund? Thinking to investments. So the 3 that we have are around funding risk, contribution risk, and liquidity risk. Those are the 3 highest. So those are operating at the highest level of ability to pay pensions, a desire not to charge contributions that are too high, and the ability in the short term for liquidity to make pension payments each month as they fall due. And then beneath that, there are all the other risks associated with individual investments, equity risk, credit risk, and so on. But those operate at a secondary level.
And Robert, as Chief Exec, are you assured by all the management of the risks within your pension fund?
Yes, I am. Probably because 2 years ago we completely redesigned the risk frameworks. We've got a risk appetite statement, we've got a risk framework for the board and for the Audit and Risk Committee. We've got an operational one for the management team. There is a process which is documented and shared on the website about when we do this, who refers to it, who looks at it, and how we oversee those. And the management team, including Peter and myself, review that every month and then take that through the various governance channels as well. So it's a pretty robust process, which is about 2 years in operation now.
Good, that's helpful to know. Luke, can I come to you now? Does the Mayor or the GLA have any concerns regarding LPFA or TfL's pension funds investment strategies?
Thank you. We have no specific concerns. Obviously, we remain in very active dialogue with both organisations to understand what the investment strategy is. TfL's pensions risks are, in some way, a little bit more distant from us because of the trust-based structure and the different governance arrangements. We are the largest active employer in the LPFA, so obviously what happens there potentially has a more direct read-through to local taxpayers via us. So we do remain in very close dialogue, but no concerns.
Okay, lovely. Let me move on to governance now. I think I might come to you, Robert, on this actually. Your internal auditors, PwC, rated your governance, risk management and control framework as having major improvements required, finding 9 high-risk ratings, of which 7 were critical risks. In details from their recent assessment on their website. What major improvements are you making to address these really serious concerns?
There's probably 3 responses to that. One, it's a relatively new relationship with our internal auditors, and those relationships take some time to bed down in terms of their understanding of who we are and what we do and how we operate. So if I may, Joe, just to extend a little bit on this answer, we have 2 organisations which we own 50% of with Lancashire County Council, called the Local Pension Fund Administration Business and the Local Pensions Partnership Investment Business. So we've got an investment business and an admin business. And sometimes, because most of our investments and most of our administration and some of our outsourced back office is with them, some of that relationship and understanding about how we operate has been less clear for the internal auditors. So there's something about the relationship and how we interact with the internal auditors. The second thing is we have taken work back from LPPA and LPPI into LPFA. So we've built up our HR, our finance, our communications. So we're taking work back, and we're in the first year of those operations and bedding those down. And what we actually asked PwC, who are the auditors, is to give us some more input as to what really good practice would be, and to almost hold us to account against the really good practice, as well as how we're doing on day one in this first year. And then thirdly, there are a couple of areas that have been of concern and were part of the 7 that you refer to, which specifically allude to a new pension system which is going in the administration business. That system is called PACE. So they're basically rebuilding the software that operates, calculates and pays the pensions. That transformation programme is going to take 15 months to finish, and when it finishes, most of those 7 that you referred to will be addressed by technology and different controls. So there is plans in place for those to be mitigated and those to happen. The other area of the 2 of the 9 that remain are largely around business continuity. And again, some of that, I'm sorry this is a long answer, but some of that is related to pretty much all the administration is done by the admin business. We don't actually process information. We don't do calculations. So business continuity is largely, is the admin business fit for purpose, and has it got the controls, and is it doing all the things it needs to, not us. And that's why I referenced the understanding that PwC about our relationship, how we operate with the administrators, and what access we have to information is kind of crucial. So hopefully that's addressed the 9 and what we're doing about it.
But wouldn't you as Chief Exec be able to talk to the internal auditors when you're presented with a draft, or when you initially have them in, because they're new to you, to be able to explain how your business operates? It seems a bit bizarre that they have published something so critical, and I think it was it's worse when you compare it with the previous years. your audit rating is worse, it makes no sense to me, because, you know, I have been in organisations, you talk to the auditors, they understand your business. PwC, it's not like it's, you know, a small organisation. Surely that's a failing there from you as a management team in terms of working with your auditor.
Just refer you back to my previous answer about the relationship. It's a new relationship. It's a new team at PwC that we've been operating with. Yes, we have conversations with them all the time about closing out actions, about new actions, about how they operate. But some of that understanding has taken a while. The understanding about how we operate with the admin business, the investment business, and what we do. And the primary difference between the previous year and this year has been we've taken back more back office functions, and those have been new, and those have been bedded down, and those are the things that have come to light in this year's report.
Okay, but apart from sorting out the programme, the IT programme, you talked about the system and bringing activities in-house, what else are you doing to ensure that your rating is better next year?
So there is one of the senior management team who's now completely responsible for the relationship with the auditors. To go back to your point about the relationship, so there's one person who's got the ownership of that relationship. Secondly, we have a senior leadership team who are looking at things like what we grandly call a target operating model, how we do things around here, if you want to think of it in those terms. So there's a lot of work on the way to plan different or improving controls or processes so that we don't rely on people so much. We've grown as an organisation from about 2 or 3 staff 2 years ago, to an organisation of about 20 people now, and with new functions coming on board. So there's a lot of work about how we do things around it, the target operating model, and how we process and how we interact with each other.
Okay, and why did you redact reference to the critical findings in the audit report from the minutes of your Audit and Risk Committee on the 19th of July 2022?
I'd have to take away and find out why that happened, but we do redact a number of things, so I have to go away and check.
Okay, thank you.
Perhaps that's something you could send on to us afterwards, in light of not being able to answer that now. Could you just refresh my memory? Who were the auditors before PwC?
Deloitte's.
Right, okay, so still amongst the big 4. So
it's a rather small community of auditors who do local government.
It is, and you know, for those of us who worked in sort of the housing and some of the sort of associated with local authority, with some of these organisations that have had audits and that's then proved to be somewhat awkward. I'm hoping that there's nothing like that that's lurking here. Okay. I won't mention the word Carillion then, obviously. I will move on, however, to Assemblymember McCartney, who's going to ask you some questions about ESG, as it's commonly known, environmental, social and governance issues. Thank you.
Thank you. And perhaps I can start with Peter and Padmesh. I just want to ask about your investments, and do you have a figure as to how much of your investment portfolio is actually invested in companies in London? And what are your intentions, perhaps, to increase that investment share? Perhaps, Peter, I could start with you.
Thank you very much. The short answer is no, we don't keep a log at that level of granularity around companies and where they're invested. Looking at our global equity allocation, so that's about half of our fund investing in shares in companies. Around 6% of that's in the UK, and from that, you know, most of those will be listed in London. But by and large, those are large multinational companies, and it's quite difficult to break that down into their impact in particular areas. Where we do have greater sort of specificity around location is in infrastructure, where around 50% of our infrastructure investments are in the UK, and about 3/4 of our real estate is in the UK. Now, within that, you know, it's spread across the UK. A lot of our real estate, a lot of our infrastructure is in things like wind power, solar power, and so on, where there's very limited within London itself, but it's more spread across the UK. Thinking about your question around ambition to increase that, that's what the London Fund is all about. The intention for the London Fund is to specifically invest within London itself, a reasonably broad definition of London, primarily in infrastructure, in real estate and in some cases in sort of venture capital type investments, small startup kind of investments. And our allocation to that's 150 million, which represents between 2 and 3% of our fund.
Okay, I'm just going to stick with you for a sec if I can, but the government states that its ambition is that local government pension schemes should invest. I think they've put a figure of 5% on local projects. Is that something that you're looking to meet?
Yes, so very supportive of that, and I think the white paper that was sort of launched as part of name-checked LPPI, our investment manager, and their investments together with others, but specifically LPPI in our infrastructure projects, and also there were other references to the London Fund in a different paper that preceded the white paper. So the short answer is yes, we're supportive, and we're already a leader in that space to the extent that we're being referenced by others, as a leader.
Thank you. And perhaps...
Sorry, if I may, just to add some further depth to that, you'll all be very familiar with government white papers or consultation papers. Local in this context means the UK, it doesn't mean London. And we're already at about 6% throughout the UK.
I think what would be useful, Chair, is if after the meeting we could have some written information about, and perhaps about the time frame for some of this work. I know you said you were at the early stages of looking at some of this, that would be very helpful. But Padmesh, can I ask you the same question about the proportion of funds, if you know it, that are invested in London projects?
I mean, I think we don't have a specific target to sort of invest in London, but and we don't maintain, what our number of ours for London, but I can also share the sort of, figures from what I can remember. So our single largest investment in actually London is in Bexley, Belvedere. So actually we own around 12% of I think the UK's largest energy from waste facility. They're called Corey. So that, I think we own about 12%, and that was roughly about 140 million sterling. And actually Corey is going through, quite a large, expansion, Corey 2 or Riverside 2 as they call it. And we'll be investing a further close to about 75 million in that facility, which I think goes, the construction should be starting sometime later this year and should be completed by sort of 2025. So I think that's our, I think single largest footprint in London. And I think from a kind of a exposure to UK, I think that's the way sort of we tend to, see our allocations, how do we do versus the benchmark. I think roughly our fund is invested, I think about, 15% of our assets are in UK, across the board. That's equities, bonds, and the sort of the private market. And I think the view my trustees sort of have taken that we're trying to diversify versus TFL risk. I think that's, the single most, because as they are our sponsors, that's the covenant risk we have. So the risk we're trying to diversify is TFL. In some ways, TFL and London are two sides of the same coin. So what we don't want is to put all our sort of eggs in the London basket purely from a long-term sustainability perspective. I mean, we it's a fantastic city. It offers some, really great opportunities. But just from that risk return framework, we just have to look outside. And if there are good opportunities like Corey, we definitely will do that.
Thank you. And can I ask, I think it's probably for you again, Padmesh, that have you considered investing in the London Fund? And if so, what discussions have you had and what was the outcome of those?
No, I don't think we have.
Okay, is that something you will look at in future?
I mean, our trustees are sort of, quite open to, discussing these things. And I'm sure, I think, once there is sort of clarity on that, I mean, it's for my trustees to sort of take a view if that's something for our fund or not.
Okay, thank you. And perhaps I could just ask Peter or Robert, is that something that you've looked at as well or not, or made approaches to TFL?
So we haven't specifically spoken to TFL because at the minute the strategy is to grow the London Fund via the London boroughs. So we're investing a lot of time and energy with LPPI and the LSIV, the other pool that's involved, in speaking to the 31 boroughs and trying to get them to invest. So hopefully, we've got one at the minute, hopefully we'll have 2 or 3 more in the short term. And once we grow to a certain size, then we'll look at other investors coming on board as well, who may include TfL.
Thank you. Thank you, Chair.
Thank you. We're now going to, we're making a note of the things that you've offered to send us, so we will write to you afterwards and just refresh, so you don't feel that you need to capture that, although obviously that would be welcome as well. I'm now going to move on to Assembly Member Fortune, who's going to ask some further questions about social impact and that whole area.
I will, but I will first congratulate Padmesh for his huge investment in Bexley. It's a sound investment, and Bromley's very close as well. We'll have some of that. The ESG governance process is really interesting, and I slogged through. I think I said before, I slogged through the Mark Carney book. I understood about a third of it, but one of the real challenges in that was about how you measure success, and it was interesting looking. The other day, I read that some of the pension funds that are signed up to the G fans. I think it was, there was an Australian one and a German one, a CB Bus Super, I think. They pulled out of measuring their success along those ESG frameworks because it's so challenging. So how do you ensure that you're meeting those challenges, and how do you reassure yourself that you're sticking to those guidelines? Yeah, Peter, it's probably best, yeah.
It is a challenge, absolutely, because the kind of impact or the ESG issues that affect each investment or each company are very different. So there are a range of different ways that we measure that. I mean, there are sort of available ESG scoring kind of metrics that we use. Increasingly, we've made the net zero commitment as part of the IIGCC net zero investment framework, and that includes picking metrics and sticking to those. More broadly, though, I mean, it is challenging, and it's done on a case-by-case basis. We work closely with Lppa, our delegated investment manager, to ensure that ESG approach is integrated into investment decision-making right at the point that the investment decisions are made, and then monitored from that point onwards. Rather than trying to kind of treat it as a separate list of things that need to be addressed. And our direction to LPPI is done, we have lots of interactions with them, but at the highest level through our responsible investment policy, through our investment strategy statement, our climate change policy, that kind of sets the tone for what's expected of them in their investment decision making.
So I think that's right, because it's setting the tone and definitions.
Absolutely. It sets, in a reasonably concise way, it sets our expectations for the kind of approach that they will take, rather than being deeply specific and sort of tick boxy of what kinds of things we do and don't accept. Because from the board's perspective, it's very difficult to take an opinion on individual investment matters, and that is for our delegated investment manager. We don't want to tie their hands.
Yeah, and that's what I mean, and you can see how easily one might progress down that route. So my previous question, which was, okay, we're going to invest in affordable housing,
yep,
and we're going to put that with an ESG framework. The next question is, well, how many have you delivered? Yep. And that becomes an issue. And then what we're seeing with some companies as well, I'm trying to be completely objective here, is they're sort of backing away from the commitments they've made because they find that it just butts up against some of the fiduciary responsibilities they have for a financial return.
Yep.
And you're seeing that with some pension funds who have invested in, say, fossil fuel companies who are saying, right, we're going to back off now from our target date of when we're going to extricate ourselves from those investments. So that measurement of ESG, I think, is really interesting. So Padmesh, in terms of what the TfL are doing, how have you integrated ESG principles into your pension fund? And again, sort of the same question, how do you measure it? Because exiting from these commitments is not a great place to be.
Thank you. Thanks for that question. I mean, as I'm sure, I think probably it's quite well sort of publicized. I think the TfL pension fund announced a very ambitious net zero target sort of last year, sort of, net zero by 2045, 55% reduction by sort of, 2030. And when we sort of looked around, obviously, we thought hard, because absolutely on that point, we knew once you stick your neck out, you can't back out, right? I think so we did sort of, we thought hard about sort of that question. So that sort of set the scene. That has set the scene for our sort of the pension fund. I think but I mean, clearly, I don't think just the carbon is the only issue for TfL pension fund. And actually, we've been publishing our sustainability report for 5 years now. Actually, it's the 5th report we'll be publishing this year, and that's actually just to engage with our stakeholders. We actually tend to think about this issue from 3 lenses. I mean, and so it's almost like our broadest lens is what impact our investments are having on the ground. And we use the United Nations 17 Sustainable Development Goals to almost say, okay, if we are investing our capital on the margin, is it having any global impact? And we tend to think quite globally, sort of on that framework. And actually, if you look at our sustainability report, we actually benchmark our investments versus the benchmark. How are we doing versus those 17 goals? Which are the areas where we can improve? What are the, is there anything obviously missing out there? So, for example, one of the things that sort of came out from this benchmarking exercise last year, that we're not doing as well on gender equality, right? That's one of the 17 goals. And we said, okay, what's happening? And then when we started unpeeling the onion, we realized that that's because of our allocation to some of our emerging market stocks, where clearly, gender balance is not properly balanced at the board level. So clearly we knew what the problem was, and then we almost started taking that almost as a talking point with our managers. So that's the kind of the broadest lens we look at. The second lens we look at is the ESG, I think, which my sort of fellow talked about. Here, again, we use multiple scores, and I can tell you no score is perfect. I mean, but that's why we tend to use more than one. So we use Sustainalytics, we use MSCI, ESG scores. And believe me, I think, once you start, and there are issues, but that's the best we have sort of available. And then the third one is literally the carbon intensity, and we track both. So we use the WACI. I mean, apologies for sort of using these. It's just the weighted average carbon intensity. And we also measure the absolute sort of the carbon footprint of our portfolio. So I think so that's the way to, and I can tell you, I think what's been happening over years is that the data quality is improving. But think of our fund. I mean, only 40% of our fund is in public assets. The other 40 is in private. And I think that's where the challenge is, just improving the data quality across the board. And that's the area we're working on.
And then you can see you reach a point of almost cognitive dissonance where you've got financial responsibility, but you're trying to put the ESG responsibilities as well. And if you become too granular in terms of the measurement, you can lose sight of the finance. So if I could run back to Robert with the LPFA, has there ever been a request for the LPPI to take a non-financial approach to an investment? And I know that's allowed in the strategy, and I know the 2014 judgment as well. But something, an investment out of principle rather than finance.
That's an interesting question, because you're right, we have got that. We are okay to do that if we chose to do so.
I can respond. So we are okay to do that if we chose to do so. We sort of almost reserve the right to do so in our investment strategy statement. There's a sentence there, along those lines. The approach that we have taken to date, I'm not aware of any specific investments decisions where we have sort of deviated essentially from our fiduciary duty. So I don't want to kind of confuse that with not caring about ESG. The reason that we do care about all of these things is because absolutely they are tied in with the long-term financial success of the fund. And that is the lens through which we see all of these issues. So you have knock-on risks around reputation,
So they're not perfect examples, but I've got 2 examples, if you indulge me, which might give some more light on what you're asking. So we divested from Exxon a couple of years ago. Yeah. And we divested from Exxon on the basis of an awful lot of engagement via our investment managers, LPPI, and the US managers in trying to see if management would change. So at the end of that process, we and LPPI said they're not going to change. It's not a financial decision. We don't think it's right for us, and we're going to come out of Exxon.
But you can square that as a governance decision as well, right?
Absolutely. So that's one. It's not a pure example, but it's a good example, hopefully, for colleagues to understand. And the second thing, because it's really interesting where your narratives are going about people backing away from some of this, the whole premise that we started the London Fund from was almost like a double bottom line type thing. So we want a financial approach, but we as a board sat down and debated and argued and discussed this, and we want to do some social good as well. There are two objectives for the London Fund. One is explicitly doing some good, as well as making more than the actual benchmark we've got.
I started by saying it's fascinating because I don't know how you measure it. And last one, Chair, I promise, which is to Luke as the GLA representative, is that what we'll be running from next year, of course, is a climate budget alongside the standard GLA budget, which means you're going to have to scoop all of this up and define it in terms of the impact on the climate. So how do you work with all these partners to do that?
We have a very active dialogue already to understand the data in both organisations. Obviously, to deliver the climate budget, I think we've discussed at this committee recently, we are increasing our resources in terms of carbon analysis and associated financial modelling capabilities. So that new team, which is being established under my unit, will be pulling that together for the GLA Group, and we'll be working very closely with these organisations to take a holistic view.
But unilateral decisions that Robert makes and Padmesh makes and Tim makes will have an impact on that climate budget, won't it?
They will, yes. So the group exposure includes the pension fund exposures, so we will be collating that also.
Good luck. Cheers. Thank
It's
you.
a very complex task.
Well, that's one of the reasons why we wanted to explore all of this area today. Actually, I don't think it was this committee. I think it was Assembly Member Fortune's Budget and Performance Committee where you were talking about climate budgeting, but I've no doubt we will come back to it at some point here as well. But in the meantime, I'm going to move on to Assembly Member Russell, who has some further points to make.
Yes, thank you very much. And actually, just picking up on the climate budgeting, in terms of the GLA, we're looking at, for next year, Scope 1 emissions, and the year after, Scope 1 and 2, and then the year after that, Scope 3 emissions. And I just wonder whether when you're looking at carbon emissions in relation to pensions, are you looking at just Scope 1 or are you looking at Scopes 2 and 3? I'm not sure who would be best to answer that.
Maybe start with Padmesh?
Okay.
Sorry.
So I think I can comment on our sort of the net zero targets. I think they're very clear from a methodology standpoint. So they cover our pension fund Scope 1, 2 and 3, right? So our Scope 1 and 2 are quite clear. And our Scope 3, which you can imagine is the largest footprint, is the carbon intensity sitting in our investments. So it covers all three. And then I pick our Scope 3, right? So now I'm talking about our assets Scope 3. Then they themselves will have their own Scope 1, 2 and 3. So from that angle, we just, because there's no Scope 3 data for, many of our investments as of now. So it only covers Scope 1 and 2 of our investments. And I think our net zero announcements are quite clear that we will evolve as the market evolves in terms of actually giving us the data around sort of the Scope 3. So we want to be very ambitious, but obviously we didn't want to make an announcement when there's no data out there. I mean, it wouldn't have sounded credible at all.
Yeah. So do you think that by being ambitious for these funds, these pension funds, in terms of the scopes, which scope of emissions you're talking about, that you can actually influence the markets and influence at least getting that data shared more readily?
Absolutely. I think that's the sort of the key point, because there's a saying, you don't ask, you don't get, right? And I think we just want to be stubborn on this point, because if we don't signal our intention, managers are just not going to become different overnight, right? So I think, and I think increasingly what you're seeing in the industry, everyone is putting their stake quite clearly, and almost there's an expectation that if the managers don't change, they lose business.
Yeah.
Right. So, and I think it's very important that our money should deliver that purpose. And I think, the important thing is that we all need to stand together on this. And increasingly, many pension funds, just not us, have similar expectations. And you can clearly see the change in behaviour on the parts of managers.
Thank you. That's very reassuring. Peter, did you want to come in on this point?
Pardon me. Just to echo that individual actions by any one pension fund are very unlikely to make real world change. We're clear in our net zero positioning as a TfL and others that we're talking about real world change here. We can change the statistics for a pension fund quite easily by financial engineering. We could sell the something and buy something else, but that doesn't really change the real world. Our target is to change the real world and to accelerate the transition, and you can't do that by yourself. It's about a collaboration and a coalition of lots of asset owners together, all acting in the same direction to be able to achieve that change.
And organisations that sort of have public purpose at their heart, like the GLA, TfL, etc., there's even more of a duty to be leaders on that. Sorry, Robert, were you wanting to come in on this as well?
Yeah, just to give you another couple of examples which might help. There is some influence that we can do at the pension fund level through organisations that work in this space. So there's an organisation called the Transition Pathway Initiative, which measures the transition to a greener economy, and LPPI sit on the main committee for that organisation and therefore have a voice and have an influence on how those metrics get set and kind of extending their operation. And colleagues in Lancashire sit on the executive committee of something called Lpfa, which is the local government pension authority that does a lot of work in this space. So there is real influence we bring to bear in the pension space through some of these other organisations that we're actively involved in.
Thank you, thank you. So my next question is for Padmesh. Now, I'm not sure when the TfL Pension Fund adopted its net zero carbon emissions plan. I think you possibly said it was a year ago, but it might...
It was, I think, October last year.
Yeah. So since then, by how much has the fund reduced its carbon emissions? And do you think you're on track to meet the interim target to reduce emissions by 55% by 2030?
Yeah. I mean, I think because I think our baseline is 2016, and so that's the year we said, sort of in terms of actually measuring our sort of the progress. So if I just compare everything versus sort of our baseline, we are roughly down about sort of 35%, a little more than sort of a third in terms of our carbon intensity. So clearly, we're going sort of in the right direction. And actually, we also measure us against our benchmark, right? So one is, and you can imagine what's happening in the real world, that we are, it's almost like you're running on a travelator, and travelator is running faster because the benchmark itself, like all the companies taking action, so we have a kind of a hurdle that keeps going up. So clearly, we are ahead of our hurdle, which is, again, a sort of a good news. Now, one thing I think my trustees are sort of quite clear that, clearly the targets are 2030, 2045. So we're not expecting kind of a linear number year on year because certain things are not in our hands. We might be doing some really great investments, and there could be other years where, something beyond our control happens. So I think this year was a classic one, and I'll be very open and honest here. So actually, if you look at our carbon intensity, it's almost flat, or actually it might have even gone up slightly, not because we have actually gone and bought more oil and gas stocks. If anything, actually the quantity of stocks that we hold actually fell slightly, but those, you can imagine the market was down 30%. But oil and gas stocks were up 50, 60, 70%, right? So it's just the price effect. And so in that, so I think some of the sort of the dollar or the pound footprint of those investments went up, because of which our WACC score might have gone up slightly. But again, clearly the focus of trustees is not to focus quarter and quarter. Focus on the sort of the long-term target, 2030. And in that long-term thinking and sort of implementation, we are literally going after every attractive opportunity that we're getting to actually deploy our marginal capital to transition to a net zero world. And I'm not saying, I talked about Corey. I'm not saying Corey is the best example, but that's one of the so many examples of the investments we are actually looking into. As we speak, we are looking at $50 million investments in Brazilian largest solar platform in Brazil. So I think what I'm saying is that we are just going after the best marginal risk-adjusted investments, which will allow us to hit the targets. But there will be bumps on the way, so we may not fall linearly, month on month, year on year. But the focus is quite clear.
Just to clarify, do you hold oil and gas stocks?
Yes, we do.
You do?
Yes.
And how does that... I mean, in particular the oil, how does that holding of fossil fuel stocks sit with the kind of all the net zero ambition?
I mean, again, I can sort of talk for myself, the trustee. So I can tell you the numbers. I think roughly, if I take across the board, both equities and bonds, our allocation to oil and gas is roughly about 2.2% of our sort of the fund. And if I just take the equity alone, that's about 1.8%. Obviously, that's well below what's there in the sort of the benchmark. Now, I think the view trustees have taken on this oil and gas holding are twofold. I mean, number one, we are trying to hold a diversified portfolio, and clearly, one may think oil and gas is bad, but there's a role for these stocks in the short term. I mean, clearly we're still reliant on energy, so so it's part of the sort of the diversified portfolio in the short term. And I think the second one is, it's very easy for us to just hit the targets just by divesting from anything we hold in oil and gas. And I think the question is, once you leave the table, how do you then engage with any company? And I think engagement is a big part of, I think, what our trustees are trying to do. And, they talked about our membership of organizations like Climate Action 100, Carbon Disclosure Project, so on and so forth. I mean, you can only go and push companies to do something, whether it's Shell or the BPs, if you're actually owning those companies. Once you leave the table, what's there to influence? And I think on the margin, I think, it's better for responsible shareholders to be owning these companies to make the right changes. Because if we all divest, I don't think it's making any real life impact, because less responsible owners will hold the shares, and probably they don't care about climate change.
Thank you very much. My next question is for Peter. So since September last year, when LPFA set a commitment to achieve net zero carbon emissions in its investments by 2050, by how much has the fund reduced its carbon emissions, and has it set an interim target for 2030 as it suggested it would?
We are signing off, so to answer the second part first, we are signing off that, we're putting it to board later this month, and it will be published straight after that. So we're expecting to publish it towards the end of October, early November. So yes, we've spent the last year working through some of those numbers to set an interim target. Since last year, so the periods that we're looking at, we're benchmarking relative to 2019 as our starting position. The latest position we have is at March 2021. And the position there showed around a 70% reduction during those couple of years. And that mainly reflects the fact that a couple of the divestments from oil and gas stocks during that period of time.
So that's a sort of probably a non-linear.
It really is.
So it's a big drop and then it'll flatten.
Very much so. And the position that we find ourselves in is that, following a period of engagement, we now have an exclusion for extractive fossil fuels within our listed equities portfolio, and that's the area that we're initially focusing on because it's the largest part of our portfolio. And what it means is that yes, over that period of time, there's a large reduction, but it means that the remaining 30% of emissions are slightly more challenging, so it will be a shallower curve towards 2030 and 2050.
Thank you very much. And then Luke, has the Mayor or the GLA made any representations to the LPFA or TfL pension fund in recent years to influence or inform their investment strategies, including in relation to ESG factors?
Apologies. I think it's fair to say that there's been very active encouragement in the development of best practice in ESG strategies. We're in very regular dialogue, and colleagues in the environment team and the relevant deputy mayor are in close contact with officers at the LPFA and indeed at the TfL pension scheme. Obviously, they're respecting the independent decision-making powers of the trust and the LPFA as an independent statutory body.
Thank you. And then a final question, which is both for Padmesh and for Peter, which is what is the total value of any of your assets invested in Russia, and have such investments been written off? I don't know who wants to go first. Peter.
I'm happy to. So I can follow up with the figure at the point from sort of February when we when the issues in Ukraine started. The short answer now is very, very low, and they have been written off, yes. Before they were written off, I think they had a value of around 0.1% of the fund.
Thank you very much. And Padmesh.
So I think for us, I think from memory, going into sort of this crisis, I think our funds overall holdings in Russia were roughly about 0.3%. And the day this happened, so the trustees sort of got together and a decision was taken, and it's actually on our sort of the website that there will be no further investments in Russia. So that was our first stake sort of on the ground, and there was no market in these assets. So even obviously we wanted to divest from sort of these assets, but as you can imagine, there were only sort of the sellers, no buyers for these assets. So pretty much everything was sort of written down to zero. And since then, some of the positions, particularly in the ruble, they have been sort of liquidated as and when our managers could sort of do them. But if you ask me today, allocation to Russia is zero. I mean, there's still some stocks, but they're all sort of valued as zero. And what our managers are saying that the moment they get sort of an opportunity to get at least the price, they will exit. But we are not putting any value on those holdings as we speak.
Thank you very much, Chair.
Thank you. That concludes the first selection of questions, which was around the whole area of investments. We're now going to move on to talk about costs and affordability, and we're going to come back to some questions from me. And I want to start, first of all, with Luke. And sorry for choosing between you and Padmesh earlier. I was just trying to keep things moving along there. But Luke, if we start with you and then maybe move over to Tim. How concerned are you about the level of employer contributions to the TfL pension scheme, both in terms of its sustainability and its overall cost to Londoners?
I think I should possibly defer to Patrick to talk about the contributions into that scheme, but clearly it does affect the group budget significantly.
Yes, it affects the overall budget. Well, Patrick, if I come to you and then I'll go to Tim.
Thanks. This is something that we've looked at both through the independent review into the TfL pension scheme that was published in March and our recent TfL response to that pension scheme that was published on the 27th of September. Our key concern as TfL is the anomalous private sector nature of the scheme, means the scheme is carrying unnecessary cost, but also risk. And that is our concern as an employer. Our report on the 27th of September outlines that although the scheme was in a small surplus position at the last triennial valuation, there is a 1 in 20 chance the scheme could be in a £4 billion deficit by 2024. That such an outturn could require contributions of around £700 million per annum for 6 years to pay that deficit off. So that risk is our concern. And that's something we've noted in our response and something that you'll see in our future work that we're doing on the TfL pension review. But we don't have an underlying concern about the current cost of the scheme.
Tim, did you want to add something to that?
The current cost is derived from the evaluation process. Overall, it's gone down because of that surplus, and that surplus then sort of helps keep that cost lower, because the fact that there's a very small surplus when determining the rate going forward has helped to bring that down to the lowest possible level it can, while ensuring there is sufficient to pay the future service benefits. But the cost is derived from a lot of the demographics of the fund, age and mortality assumptions.
Okay. Luke, I'm going to come back to you, but you may, of course, select someone else to answer this, but I don't think so, not this one. What is the Mayor or the GLA strategic finance view on the extent to which costs, affordability and the generosity vary between the variety of different pension schemes that we have within the GLA group? Because clearly it's really quite diverse.
It is diverse, and there are so many factors affecting the circumstances of each scheme, or indeed, if we take the LGPS, for instance, which obviously the GLA staff members are part of, also OPDC, LLDC, and some of the staff in TfL and the other functional bodies are all part of. Each of those has a different contribution rate from an employer level, just driven by the individual scheme demographics. And it's very difficult to create a sort of absolute ranking of generosity. There is, for more detail on this, there's an MQ, I think MQ 250, that I remember drafting the answer to, that tabulates the kind of current position. Things haven't moved on too far from then. And you know, depending on what measure you choose, they come out with different rankings, but broadly similar in terms of provision, alongside the national schemes like the civil service or NHS pensions.
So what you're saying is it's not so much about the differences between the inputs, but it's achieving the same outputs is what is being looked at in all of these schemes. Yeah, so even if the employer contributes 12% to one or 33% to another, the output and taking all those other variables like the demographics, the mortality rates, and so on and so forth.
Well, the output for members is the same. The issue is that the output for employers is sometimes not. So schemes can cost very different amounts for employers depending on who constitutes them. But we're operating under in the LGPS, nationally defined benefit structures. So yeah, that always means that members' experience is uniform, even if employers' experience is different.
Right. I'm now going to bring in Assembly Member Hall, who's going to ask the next group of questions.
Thank you. I think this actually should go to you, Tim. The TfL pension scheme is more generous than the other pension schemes in the GLA group. For example, the scheme's accrual is based on members' final salary rather than career average. Its normal retirement age is lower than most other schemes, and it requires the lowest employee contribution rates. So how is the variance in generosity justified by the Mayor?
I can't speak for the Mayor, but the fund is established under rules when TfL or LRT was created and the funds were merged. Those rules have various terms and conditions in them which make it very difficult to change that scheme. So, yes, you're right, the table that Luke referred to in the answer to the Mayor's question shows the output very similar, but you're right, with contributions set at the levels they are for what members pay, that has an overall different value for what's gone in.
Well, it certainly does. Is there any appetite to do anything about this?
That would be a question for the employer. From the trustees' point of view, we're there to look after the scheme and ensure that the fund rules
Patrick,
are followed.
Patrick, any ideas?
So, as you know, the current TfL funding settlement with government requires us to go through a three-step process to continue the review of the pension scheme that was started under previous government settlements, and TfL is committed to delivering on those obligations in that funding settlement. So on the 27th of September, we met the first step of that review and submitted our response to Sir Brendan Barber's final report. Tomorrow, we will meet the second step of that process, where we will outline two broad options for potential further reform, but it is important to note that do nothing does remain an option. The third step in the process is by the 31st of January, TfL and government are to agree a preferred course of action in terms of responding to those options.
Do you think we can afford to do nothing?
I think it is very difficult to look at pensions in isolation. As Sir Brendan's independent report noted, that the TfL pension is one of the only significant monetary benefits to TfL employees, and to look at that change in isolation could cause significant issues for TfL in terms of staff recruitment and staff retention. And it is important to look at remuneration in the round.
Yes, it is. So you've no idea whether this will be changed?
At the moment, there are no proposals for change, but we are committed to meeting our deliverables under the funding settlement and we will do so.
Because I think there was an independent view that there could be about 100 million saved from reforms. Is that right?
You are correct that an independent panel review in December 2020 indicated that it could be possible to save in the order of £100 million from the TfL pension scheme. I think there are two important things to note. That was at the time of the 2018 TfL pension fund valuation, when our pension contributions were £400 million per annum, or 33% as employer contributions. Subsequently, as Padmesh and Tim have mentioned, the 2021 valuation has already reduced that by £70 million per annum, and the TfL employer contributions reduced to 27.3%. So, firstly, the baseline has already changed since the date of that report. Secondly, that recommendation was looking at two factors, both considering the cost of future service, but also managing the cost of past liabilities, treating this anomalous nature of the fact that the TfL pension scheme is regulated as a private sector fund, and the government could support in making savings by offering something like a Crown guarantee, which is what that independent report noted.
Okay, I hear what you say. What is the anticipated impact of current and projected inflation on the cost and affordability of the GLA Group pension schemes? I think that should be either Peter or Tim. Peter.
Thank you. So the recent high levels of inflation do affect our pension contributions, our pension outgo to members, and we would expect that to increase starting in April next year. It's one of the items. Sorry, could you repeat the question? I'm not sure of exactly the.
What's the anticipated impact of the current?
Yeah. So again, I come back to we're a very long-term investor, and when we are selecting investment, both at the highest level of strategic asset allocation and then at lower levels, we are looking for assets that provide us an inflation, perhaps not linked return directly, but assets with significant inflation participation. What that means is that over the long term, we still expect to be able to meet all of the pension obligations that we are responsible for. The current funding level of our fund altogether is in the region of between 120, 125%. So there will be an impact. Primarily, our focus is on the short-term impact of liquidity management to make sure that we can pay pensions as they fall due over the short term. Over the longer term, it's very difficult to say whether there will be an impact or not, but we have deliberately baked into our investment strategy an intention to ensure that over the long term our asset returns give us a return that's above inflation.
Okay, well, the next question is linked, but this is for you, Tim. Roughly what proportion of all TfL pension scheme members who retire each year do so early, i.e. before the age of 65, and what proportion retire before the age of 60, and have these proportions changed over the recent years?
They're not figures I have to hand, but I can certainly provide those afterwards in terms of the exact proportions. But I think the average age from memory works out around 60 when we looked at valuation, but they're numbers that we can pull out and submit.
Looking at the trend, is it going down? Are people retiring earlier or later?
It's fairly static. Seeing it from a day-to-day point of view and the operational side of it, a lot of people are carrying on working. So it's not necessarily a rush to get out of the door. There was immediately post sort of lockdown, a number of people had sort of stayed on during lockdown, and that sort of increased retirement levels, but not to a significant extent.
Okay, can you send the committee those details? Because I think we'd find those helpful, Chair. Thank you.
Yes, please.
Peter, roughly how many members of the Lpfa are likely to be affected by the McLeod remedy, and roughly what will be the total additional cost to the fund?
Those aren't figures that we have to hand, and I don't think the cost to the fund is not something that we know yet. The actuaries have placed a value on that for the current valuation, which I can ask to be isolated and can come back to you on that one. In terms of the proportion of members that might be affected, again, I think we have around 20% of our active membership that could be eligible to have an effect, but the individuals that might see an uplift to their pension all depends on their salary projection over time, you know, their salary experience, what they have been paid over time. Those are the calculations that we need to do, and we are just at the very beginning of that process of collecting data now, and it will be some time before we're able to put a number on individuals who are receiving additional pension or are entitled to additional pension as a result of the McLeod judgment.
Okay, I think I'll leave it there. Thank you very much.
Thank you. Thank you for that. I'm now going to move on. We're now going to move on to something around administration, and Assembly Member Pigeon is going to be starting the questioning in this area.
Okay, lovely. Thank you. I think I'm going to start with Robert on this, if I can. Do you still have any concerns about the LPPA's new pension administration system?
The short answer is no. The implementation is going well. We're halfway through. There are 18 clients, including us, in the admin business. We have successfully implemented half of those. Lancashire, which is the biggest client, goes in October, and all clients will be implemented by the end of this calendar year. There's then a period of work which is being planned to change the operating model behind the software, and that's on track as well, so I haven't got any major concerns about that programme.
So does that include Project PACE?
That's called PACE, yeah.
Yeah. What about LPPA's engagement with you and employer training? Have you any concerns about that still?
No, I think there's been quite a robust process for early engagement about what the changes will look like, what employers need to do, and there's been a number of training sessions with individual employers across the whole of LPFA, and that's been supplemented by Peter's team actually engaging with employers who need additional support or want a bit more hand-holding about some of the changes that are operating. So that's been pretty robust.
Do you have every confidence then in this new system?
It will completely transform how administration is done. It will produce a more efficient output and better member experience.
Okay. And will you publish the minutes of the 21st of June 2022 and 20th of September 2022 local pension board meetings as a matter of urgency?
I think they're due to be published very soon, aren't they?
Yes. So there was a slight delay. I believe that the first one of those dates, if it's not already, it should be there immediately. Each board minutes are signed off at the following board, so the September one will be signed off and published in November.
Okay, but June's not available.
June was not available. I think it was just absences around the ability to upload them. It was a purely administrative point rather than. So the minutes themselves were signed by local pension board in September on that 20th of September meeting, and it's just been a few weeks delay in putting them on the website.
Okay, and will you commit to routinely publishing the LPPA's quarterly performance reports alongside the local pension board agenda packs?
I think the question about what information that's to the local pension board or to the LPFA board is what is published publicly is a question for them, but it's absolutely something that we can come back on. It's not a question for officers, but we can take that one away.
Okay. And why did you redact portions of the minutes of the local pension board from February 2022, which showed concerns about the move to a new administration system?
Again, I think we'd need to come back to that on the policy for redaction.
Robert, do you know? Because obviously, we like to be transparent.
We will go away and check.
Okay,
there are lots of moving parts in this process, so it's a healthy debate. The local pensions board, for colleagues who aren't familiar with it, is primarily tasked with looking out for the member and the employer side of things, and it has representatives from members and from employers, so it's a very healthy challenge. And they do go through the pack from LPPA in some detail, but I'll specifically look into that particular meeting.
Great, thank you.
If you could, that would be very helpful. And there's a few more things that we'll be sending on to us as a result of that section as well. The next area that we'd like to look at is the TfL Independent Pensions Review, which we have touched on to a certain degree already. And I'd now like to move to Assembly Member Fortune.
Excuse me, Chair. I've got a colleague here who's our Chief Officer Pensions Review that we would like to get onto the panel if possible for this part.
Now?
If you would like to move on to questions about that subject, it would be very helpful.
It would be helpful to add, is that Tricia Wright? Where is Tricia Wright? Behind you. Okay, hang on 1 second. Right, I've just adjourned the meeting. Would you like to come through? Except there's now not going to be quite...
Chair, do you still need LPFA for this session, or is there further questions for us?
Tricia Wright, who's joined us as the Chief People Officer from TfL. Welcome. And Patrick Doig and Luke Webster are spending the entire afternoon with us, I think, or at least only on this item, but that's going to be quite a lot more. So moving on to the TfL Independent Pensions Review, and I'm handing over to my colleague, Assemblymember Fortune, who is going to start with an area around the review assumptions.
Thank you. Some of this has already been covered excellently by my colleague, Assemblymember Hall, but that's okay because I can freestyle. I think it was mentioned earlier about the difference between the output. I think it was you, Patrick, were talking about the difference between the output and the employer contributions. And that's actually the main difference in terms of how you assess a pension, because that's a lot of the way that you can tell the cost and affordability of a pension scheme. I don't think we pulled the numbers out. So for the GLA, the OPDC and the LLDC, maybe this is for you, Luke, do you know what the employer contribution rate is for that?
For those two, Peter, it's about 12%.
That's 12%.
Yes.
So that's the employee contribution at 12%. So Patrick, for the main scheme for TfL, what's the employee contribution?
The employee contribution is 5%.
5%. So what's the main contribution from TfL?
The current TfL employer contribution is 27.3%.
Yes, well done, well played. But yes, that's what I meant. So 12% for the GLA, the OPDC, and the LDC. And it was, sorry, say that again, Patrick?
The employee contribution is 5%.
Employer contribution.
And the employer contribution is 27.3%.
Employer contribution is 27.3% against 12%. Okay, right. So, and then just some scooping back to bring us back up to where we are in this section. You talked about the actuarial valuation from 2021 and some of the changes that were made there. I think you said earlier, I tried to note it down quickly, there's a £70 million change per annum, is that right? And you also said that it covered off some of the previous liabilities. Could you just tell us a bit more about that? Sorry, or Tricia, sorry.
We'll be a little bit, but I can take this one. So in the 2018 valuation, the scheme was in deficit at that point in time. The deficit was in the order of £600 million. In the 2021 valuation at 31 March, that had improved to a surplus position of 179 million. So as a consequence, TfL as an employer is no longer required under this valuation to make the deficit contributions that we were making previously. So that is the key factor in the reduction from the previous 33% to the current 27.3%, or in pound terms, from £400 million a year down to about £330 million a year.
So it's gone down from the 33%, it's gone down from 33% to 27.3%.
Yes.
And did that valuation affect any of the other underlying financial assumptions?
At every valuation, all the assumptions are taken into account. And for example, in that valuation, we made the assumption of the change from RPI to CPIH in about 2030, for example, but there'll be a whole host of technical valuations that are undertaken by the trustees, the actuaries, both on the employer side and the trustee side.
Okay, right, thank you. And now this section is talking about the independent pensions review. Could you just outline for us some of the main findings from Sir Brendan Barber's review of the TfL pension scheme?
Yeah. Good afternoon, everybody. So yeah, I'll just summarise where we got to, and we're very grateful for Sir Brendan and Joanne Seegers for undertaking that review. I guess Patrick mentioned earlier about the TfL pension scheme, that it's classified as a private sector scheme, and because of this private sector classification, it is carrying unnecessary cost and risk that actually Sir Brendan and Joanne noted could be addressed by reclassifying it as a public sector scheme, and we do strongly support this view. And we have emphasised that reclassification would dramatically improve the TfL pension scheme's funding position and resilience. Sir Brendan was also very, very clear that some reform options should be ruled out on the grounds of fairness and adequacy, and these include defined contribution and collective money purchase arrangements. And we also agree that these arrangements should be ruled out due to considerations around fairness, that I mentioned earlier, adequacy, and certainty of income in retirement, and recruitment and retention, which Patrick's already mentioned earlier, and that the TfL pension scheme should remain a defined benefit scheme. Patrick also mentioned earlier about, we should consider the pensions in consideration in the context of the overall TfL's overall remuneration and benefits package. And we have been explaining to government that any changes to the pension scheme will have a knock-on effect, knock-on consequences for benefits and remuneration elsewhere. Highly valued by our colleagues, as you would imagine, and the scheme is one of the only significant benefits beyond, as Patrick said, pay, and changes to it could make us less attractive as an employer. And we are in a very, very competitive market at the moment, and we are seeing attrition in a number of areas. So it could reduce our competitiveness in the jobs market, also pose a risk to our ability to recruit and maintain going forward, and talent going forward. And this is particularly concerning at the moment, given our current challenges going forward. If we look at, and Sir Brendan highlighted that any reduction in TfL's pensions contribution will almost certainly result in a reduction in members' future benefits earned. The August 22 funding agreement required that we should aim to reduce, as was mentioned earlier, the future service costs of the TfL pension scheme by around 100 million. We have stressed in our response that we feel the saving target is too high and would result in unacceptable impacts on colleagues compared to the benefits available in public sector organisations.
Sorry, just stop you there. In terms of the savings target, do you mean the 100 million?
So that was the 100 million that was mentioned in the funding agreement.
Okay.
And as Patrick's mentioned, that was something that was referenced in the independent report, not the Sir Brendan one, the one before that in 2020, but that was based on the 2018 valuation, because the 21 valuation wasn't public until 2022.
Yeah, which is what Patrick said earlier. So,
yeah.
And I appreciate you'll be putting some meat on the bone with this in the upcoming days, and you've got the findings tomorrow. But what's a sort of reasonable figure, do you think, ballparky?
We can't go into the deal. We just think that that is an unacceptable figure, and we're obviously going to do more work on that going forward as we assess.
Okay, so a figure which I know you're going to do more work on, is it going to be a long way from that? And I recognise that that's subjective.
I don't think we can comment on that at this stage because it's a complex issue and we've got to work that through.
Okay. I'll leave it there for other colleagues. Thank you.
Thank you very much.
I was just got one other
comment,
if that's okay.
I was going to say, I can now see several hands have gone up. Did you want to add something to what you just said, and then we'll bring in
No,
Luke?
just one final point, if I may, Chair.
Sure.
So if any changes were to be made, the government, we've made it very clear that it could take years, not months, to undertake a reform. I'm sure others will recognise that reforms in other organisations have taken a considerable amount of time. But they would also be entirely dependent on the support of the government, and including support for past service and any required legislation that goes with that. So we are explaining to government that a significant level of its support would be needed before any future decisions for reform can be made, and we need to understand if faced with all the facts that the government will support us or not.
Thanks, Tricia. Luke, you were wanting to come in as well.
Certainly. So, just for the accuracy of the record, Chair, the number I gave Assemblymember Fortune was the employer's contribution. Employees in the LGPS pay between 5.5 and 12.5%, depending on their salary band.
Two very different things, and good to be accurate on the difference between employer and employee contributions. I'm now going to move on to Dr. Onka Sahota. Assemblymember Sahota is going to pick up the next few questions.
Yes, and these are questions about the review process, and they'll be all to you, Patrick. The TfL was scheduled to meet with the government officials on the 4th of October to discuss the response and work plan. Did this meeting take place, and if so, what were the main areas of contention and agreement?
It did take place, and my colleague Tricia was there, so she can comment.
Okay.
Thanks. So, as Patrick outlined in his letter to you, we did meet them on the 4th of October, and as with our discussions with government throughout the earlier negotiations, we're not able to give a running commentary on every dealing we have with officials. However, we can confirm that it was accepted by officials that we had met the funding agreement milestone deliverable, and we'll all obviously be meeting them again with officials following the submission of the next report, which is tomorrow.
Let's move to the next question. That TfL is required to submit 2 categories of options for future service reforms alongside the detailed analysis and rationale by tomorrow. What are the core elements of the 2 categories of options?
So, in line with the requirement of the funding agreement, we will be writing to the government, as we said earlier, tomorrow, setting out the response for further consideration. And we'll be happy to share that with the Assembly. All our reports have been made available and published, but you'll appreciate that we do need to first communicate that with government and with our own staff as well.
After you've sent the letter to the government, you'll publish it on your website. Okay, thank you. What activity will take place between now and the 31st of January 2023 when you're required to reach agreement on a final detailed reform proposal?
So after making our submission tomorrow, we will again engage with government officials to make sure they understand the submission. As it is, this will be a more detailed and complex submission than our previous one, given it's taking it to the next stage. And then we'll have a series of ongoing meetings with both government officials as well as internally with our colleagues and trade unions to understand their views on it. But we're certainly very clear in the first submission that any reform, if it was to be considered, is entirely dependent on government taking action. So before we can progress too far down those discussions, we do need to understand the government's willingness to support in this regard and the types of actions they might be willing to consider.
Okay. Just to add to that, if in the the response to the independent report that we submitted on the 27th of September, there is a work plan which outlines some of those key headline activities that would need to take place and what would be required.
And of course, you'll also undertake detailed modelling to assess the wider impacts, both in terms of finance and equality impact of the reform options. will you commit to publishing your modelling that you'd undertake?
We will certainly commit to publishing the report, which will go into some detail about the assumptions that are underpinning those models. We do the full modelling with our advisors. I can't commit at this stage to publishing the actual detailed model, but that is something we'll take under consideration and respond to you on.
Great, thank you.
Thank you. I've had an indication from Assemblymember McCartney that she would like to come in just now as well.
Yeah, just ask you, are you aware of the government doing this level of micromanaging and reform with any other organisation?
In general, no. Actually, some of my colleagues met with the Atomic Weapons Agency, which actually is going through some pensions reform that are not entirely dissimilar. So we were able to share some of their experiences. They are more progressed down that. That started back in about 2016. And government recently passed enabling legislation that could potentially give them a Crown guarantee this summer. So we were learning from their experiences, but in general, no, we're not aware of any other comparable experiences.
Okay, and so the ultimate thing you would require from government is a guarantee?
Well, there are a number of ways the government could support. Sir Brendan Barber and the original independent panel from report from 2020 did outline that a Crown guarantee could be one of those solutions. Some of the other ways the government could support is changing that private sector status to a public sector scheme. And again, there are a number of different technical ways that could be achieved, which we have outlined in our 27th of September submission, and there'll be more details on that tomorrow.
Thank you.
Thank you. I tend to think that the Atomic Weapons Authority has a slightly different product to TfL, even if the issues around its pension scheme are similar. But I'm going to move on to Assemblymember Keith Prince, who's going to wrap up this area of the agenda with some last questions. Thank you.
Thank you, Chair. Good afternoon. First question is for Patrick. What is TfL's view on the government's decision to include pension reform in its conditions to TfL's funding? I think your colleagues already answered that, but if you could just give us a view.
Well, we discussed this with the Transport Committee on Tuesday, where the Commissioner Andy Byford basically effectively set out that we are very grateful for the government support that we've been provided throughout the pandemic, now totalling £6 billion as a result of this final settlement. And we are aware with such large amounts of public money there will be conditions. So we sought to make sure the conditions in this most recent settlement are fair, equitable and deliverable. We believe we have achieved that, otherwise we wouldn't have agreed to the deal. So we recognise the conditions and we are committed to meeting them.
Okay, that's very kind. I think actually Tricia's already answered the other two effectively. So, Chair, I'll leave it at that. Thank you.
Thank you very much. Yes, now we've had some very full answers earlier on. Does any other Assembly members want to come in on the item on pensions at this point in time, or any other comments that you feel that you've not covered off? In which case, I'm going to say thank you very much to our three guests for this item. We've actually finished slightly ahead of schedule, so everyone's been incredibly very helpful because it is quite a large agenda. I'm actually going to now adjourn the meeting so that should you not wish to stay for the rest of the meeting, you don't have to. And it will also give us the opportunity for some other officers who may need to speak on other items to come down and join us. So I'm going to adjourn for 5 minutes. on the food board update? As well as pay and grading. Okay. Just checking. Just to let you know that we're not proposing to take that item. So if you want to go after we've taken pay and grading, then unless you need to be here for the culture and creative. Absolutely. 10 items. I have got Susan. Yeah. Who's going first?
On culture.
I know. Susan is very cultured. Emma is now trying to be. I've got more meetings. Restart the meeting, and I'd like to welcome Tunde Olayinka, Mary Harpley, Shakira Keddo and Phil Graham, who are here to discuss the remaining papers, and will stay for the papers that they need to, but obviously if we move on to a paper that's not one that you are staying for, then you are free to go. The first paper that we're going to come to is item 9, which is entitled Changes to the GLA's Pay and Reward System, and I suspect that Mary might want to make a few remarks of introduction.
Thank you very much, Chair. So, as members will know, many members will know, this is a sort of long-awaited review, which I had intended to launch some while ago, but COVID got absolutely in the way of it, so here it is now. There are a number of recommendations related to it, as you can see, and I think also you would have also seen that they are somewhat interrelated, these recommendations. We open consultation with staff on these recommendations formally on Monday and close that consultation on the 9th of December. And we are planning a really substantive programme of presentation, discussion and engagement with staff over that period. And of course, as ever, working very closely with our colleagues in Unison through this consultation as well. I think that's probably all I want to say in introduction.
Can I just see any indications from anyone who would like to come in? If not, I'd like to say, could you just outline for the committee at this point the approval arrangements for finalising the decision? Will it be coming back to oversight so that we can look at it again after it's been out to the staff consultation? Will we be looking at it after the 9th of December? What happens next?
I mean, this paper really is the opening of my consultation with you all on this, and of course with the Mayor and the Mayor's office. So I am keen, if you've got any sort of concerns at this point going into this consultation, I would be very keen to hear those now. I'm not quite sure of the timing of the committees, but assuming that we close the consultation in the 9th of December as planned, I'm very happy to come back, say, to the January committee with an outline of where we've ended up and where we intend to go, if you would like me to do that.
Well, I believe we have committees scheduled for January, February and March, so depending on other agenda items that are coming forward, and obviously the urgency of needing to sign things off, then if January is a good opportunity, then that, we will take that and fit that into our agenda. In the oversight paper, you made a commitment to Unison and staff to review the pay and reward mechanisms, which you've just referred to. Was that commitment the primary driver of the changes, or were there some other factors that were more important?
So, Unison made a request of me to review our arrangements. I can't actually recall now, but I'd say probably after I've been here about a year. And that request was based on a number of issues with the current setup that they were dealing with for their members. I think at the same time, it had become clear to me that there are a number of issues with our current setup, although, we must also say, and I do say in the paper, that there are some good things about our current setup as well. But I think I was certainly happy to say to Unison colleagues, yes, we'll review this, because not only were they providing evidence of issues, I could see, as I got to know the organisation more, some of the things that were being driven by some of the flaws in our current system.
Now, obviously, the expectation is that this is going to be cost neutral. To what extent will pay rises be dependent on funding? Is there enough funding for everybody in the organisation to get a contribution-related pay award or pay increase should that situation emerge? I don't know who can answer that question for me.
I'll start, and then Shakira may or may not want to come in afterwards. So, of course, this all has to be affordable at any one point, and you'd have seen we sort of tried to lay out a new sort of set of philosophy and principles around reward, and of course affordability is absolutely essential, as is using Londoners' money responsibly. So that's the first thing. The second thing is probably important to say is that at the moment there are two ways staff can two routes for securing a pay award at the moment. One is the annual negotiation with Unison for the sort of so-called cost of living annual award. That will continue. That is unaffected by these proposals. That will continue and will be subject, obviously, to annual negotiation. What we're saying is that the money that we currently, in effect, deploy around increments and some other sort of recognition payments and awards that we make is the money that's already in the system that we will then redeploy to recognise contribution rather than increments going forward. But through the budgeting process, we'll have to be sure each time that the GLA budget can afford to keep that money in the system. I think the other thing I should just say, Chair, is that I don't think it will be the case that every member of staff will be getting a contribution payment every year. That the case now is that lots of people aren't getting incremental payments. So this isn't about saying everybody has to have something in this system. As I said, annual pay negotiation is different, but it will be about recognising contribution.
I mean, I think this is quite a fundamental difference, isn't it, between the current system of having the incremental pay progression versus the bonus recognition payments. What would you say is the rationale then that underlies wanting to move from one system to the other?
So I think there are two. The first, this is less of rationale, but definitely relevant. There are the civil service and local government removed incremental progression some years ago. So I'm not saying it doesn't happen anywhere in the public sector, but there's sort of increments for time in the organisation without any link to how somebody has done in a particular year, are more and more unusual now. And you know, as we looked across the sort of landscape, and as our reward consultants supported us, one of the very first things they said to us is, "Goodness, we're surprised to see this." So that is part of this. Is it still, the question is it still right now in this age? The second thing, of course, is that there are winners and losers. So if you're at the top of your grade at the moment, a very small, narrow grades, there is nowhere further for you to go in terms of pay progression other than the annual award. And we've got, at the moment, about 30% of our staff at the top of their grade. And some of those staff have been at the top of their grade for a very long time. By April, if our staffing population stays exactly the same as it is, it'll be 50% of staff. And so there's nowhere for those staff to go, regardless of how hard they work or what contribution they make to the organisation. So that's the first thing. The second thing is, across our grades, increments aren't equal. So the higher the grade, the larger the increment. And at the higher levels of our grades, some of our increments are very significant. So again, you know, where you are in the organisation defines a lot about how much you get paid in terms of pay rise. So this is about opening up access to pay progression in a very different way, but in a way that, I've got other members of the corporate management team here deliberately with me, but in a way that we as a corporate management team believe, you know, will better recognise contribution, will, we hope, motivate people to give more. Some people are giving everything they possibly can, but not everybody is. But much more of a sense of actually there are things that we expect people to do for reward, as opposed to just sit and wait for the next guaranteed increment. So it is, I accept it's a significant change, but it is also about changing how this organisation feels a little bit in terms of motivation and performance.
You referred to other organisations who've gone down this path and changed from the sort of annual increment that's not linked in any way to performance or recognition of excellence. How's it worked out for them? You know, are there lessons that we can learn from elsewhere? You know, has it worked out well?
Yeah, so from an HR perspective, I've done kind of lots of looking across organisations to see how this works out. And again, there are pros and there are cons. It's never kind of working out that everything's a perfect system by any means. But I think what we're trying to do as part of this is just take some of those learnings to what we can do to mitigate some of the things that aren't so great in some other organisations. And we're doing a lot of that through the consultation piece. But equally, how do we build that into our systems? Some organisations, absolutely, it does drive performance, it does drive performance culture, but equally, in those systems, there can be some inequities at times as well. So it's about how do we mitigate that up front before we come in to land something like this. But absolutely, across many of the organisations I've worked in previously and kind of across some of the research that I've done, this is quite the norm. It's quite a normal system. But again, it's how do we roll that out and how do we build in some of the mitigation in that piece as we go forward.
Okay, well, those were my questions that I wanted to throw in. I can now see that Assemblymember Hall wants to ask a couple of
Thank you. Only to say that Mary does know I have some concerns because Mary has spoken to us all separately. So I think it's not that we haven't got any comments. I certainly had. So I would be grateful if it could come back once we've heard or we can see what the staff think about this. But I wouldn't want anybody that's watching to think we haven't made questions and comments, because we certainly have, and I don't want our staff to think that either. So if it could come back afterwards.
No, I think that's a very well made point, and actually I'd like to thank the Chief Executive for the time that she has spent, I think, briefing us all individually and listening to a number of concerns that we've all have raised. I just wanted to bring out some of those issues, particularly on the sort of timing of, you know, next steps and whether or not we would then be able to have a look at it, and then some of those other areas that I've just touched on. But I think we have all had the opportunity to raise a lot of things privately. So I'd like to thank you particularly for that. Can I see if there's anyone else who would like to come in at this point? Assemblymember McCartney.
Yes, Mary. Yes, thank you for taking the time. I think I'm going to reiterate some of the concerns I think I raised to you. One of which is around what do we actually mean by contribution and the fairness of that and perceived bias that might come out of that. And I think you can see, you know, if we're talking about, I think you explained it, you know, do we contribute to the city, to the, you know, the work that we do at the GLA, but some jobs will lend themselves more easily to say, well, I've played that contribution to others. So my concern is, how are you actually going to explain that? How can our employees know that they are on the right track to make their contribution? I think the other thing is, of course, some people are louder than others, and they'll make that very clear. How do you make sure that those that may be quieter actually get the same deal to be able to present what they have done and get recognition for that?
Thank you, and those are really important points. I think this really boils down to our performance regime and the way we set objectives, the way we make sure that they're smart, the way that performance conversations go on throughout the year. I've worked in the civil service. The last place I worked at was Kensington and Chelsea Council, which had just got rid of its increments as well. And there's, across my experience, there's some places that do performance conversations really well, and some places that don't do it as well. I won't comment too much on the GLA other than to say that 36% of our staff felt that we don't manage performance well, and that was in the last staff survey. So the key to this will be the objective setting and ensuring that managers have those conversations throughout the year, and objectives are smart, they're measurable, they're achievable, they're time limited, and whatever role you do can have smart objectives, and then that will be the way someone goes and proves that they've made the contribution to the level.
Say, when you bring this back, will you give us a full breakdown of staff consultation responses back to us?
Yes.
Thank you. That was a very concise answer. I'm going to bring in Assemblymember Duval.
Can I just echo some of the points that have been made earlier on? This is long overdue, and I recognise that. I don't think there should be too much emphasis of getting rid of increments, because that's not the be-all and end-all of the problem that we face in this organisation. That should be based on fairness, and reward should be based on fairness, and it's not. We've got parts of the organisation that is fairly well paid. I don't do those people down. Actually, we've got parts of this organisation that are not fairly well paid and deliberately held back because they've not had someone representing or speaking up for them, or managers haven't had the ear of the senior politician in the building. That's the bits that this should be addressing, and addressing in that sense. And yes, we want a performance culture, but call me old-fashioned. Sometimes I don't think it's a be-all and end-all of a reward about money. And the increments certainly wouldn't have given me an incentive to want to do better if you give me it in another way in terms of performance. I do want to be part of an organisation that's doing things, but I want to be part, and I think the staff survey says we've got a problem here. There is a real gap here between some of the workers and some of senior management. And this is only part way in addressing that. There's got to be some issues, and I'm not sure if we've really got that quite right. Equally, I don't think it's all the manager's fault. I think there's a bit of a misunderstanding from some of our workforce about some of the issues that I've read or seen or heard in terms of some of the responses. So I think somehow we've got to see this as part of a wider package of addressing some of the issues, of bringing us in to where we should have been actually some number of years ago that predates you, Mary, and we weren't. And we lost our way. And we should be honest about that. We lost our way. So I think we will look along with you. There are lots of things that people have raised with you confidentially. I'm grateful for the way that you've approached it. I think on the Labour group side, we will be writing to you, and we're happy to share it with our other colleagues. And I'm probably happy for it to go public at some stage if you want to do a response back, so you can go into the committee issues around at this stage. But there's nothing that we're going to be saying to you that stops you moving forward. And I think there's some issues around the time that you take in moving forward in terms of certain milestones on this objective and a number of other objectives that you need to reach with your senior management team in the authority. So I just want to say that. So we'll be writing to you. We're going to share it with colleagues of some of the points we're raising, because they're not party political points as such, but just some views that we've got together, and no doubt we'll echo either your views or you'll add some more to us.
I think that's probably more of a comment from Assembly Member Old Fashioned. Now I've realised I've been calling you by the wrong name. Mary, I don't know whether you do want to come in on any of that.
Well, so thank you for the recognition of the sort of work that's been going on in the run-up to this meeting, and it was, and thank you too for your time. I think I really am keen that this is a set of several recommendations, only one of which is related to incremental pay, I think, and Assembly Member Duval is absolutely right. And the other thing, again, probably I would like to highlight is particularly the proposed new grades, fewer number, broader grades are absolutely the platform for some, as you say, Assembly Member Duval, some long overdue work on have we got the gradings right in this organisation, right across the organisation, because and we talk about this in the staff consultation. If we can move forward with that type of grading structure, we will then have a long, hard look at the jobs that fall into each grade, and whether those are right, whether some should be in the grade above, whether some should perhaps even be in the grade below. But really proper look at what grades, which jobs are where, and this builds straight to the contribution point, what our expectations are of jobs at different grades. And we don't lay that out at the moment. It's all buried in individual job descriptions, which makes it very difficult for people to be able to be sure that it's fair. So that is absolutely where we're going. I need to get through some of these changes to be able to then build on that platform. And I think staff understand that. I think we're talking very openly about that in the consultation.
Big emphasis on fairness and transparency. Assembly Member Russell.
Yeah, I just wanted to briefly recognise that the importance of that emphasis on fairness and transparency. I think it's a really difficult piece of work to be doing, and I'm very glad that Mary is doing it and is kind of is addressing something that is very difficult to get hold of, to kind of take hold of. But I think it is really a very important piece of work.
Can I see that you want to come in as well there, Phil?
If I may, because, I mean, I am going to violently agree with a lot of people, but I think it is really important to stress here the difference between the structures that we are putting in place and the manner in which we work within those structures. And I think what we have at the moment is a system where sort of unfairness is reasonably easy to hide. It's over complex, it's not particularly transparent, and it is reasonably easy for that to go unnoticed. I think the changes that we're putting in place here, I hope, will make it more visible whether we are operating in a fair way or not. But the actual test is never going to be the structures. It is going to be the fairness by which we operate within those. And I think that's the test that our staff are setting for us. I think the first part on that journey is the fact that we're entering into this consultation genuinely openly and genuinely from a listening point of view. But I think that is going to be the acid test as we move through this and get to the final set of proposals and then put them in place.
Thank you. I can't see any other indications. I think the committee is minded to accept that the consultation should go forward, and we're looking forward to seeing the results of the consultation on the pay and grading structure at a future meeting, probably January, but to be determined hopefully then. Is everyone agreed with that? Okay, that's very... Just move on to the next item, which is the proposed changing to the GLA Establishment, Culture and Creative Industries Unit. And we have two Assembly members who have some points that they want to make, and I think Phil will be leading on responding to those. So I'm going to take Assembly Member Hall, and after that I'm going to take Assembly Member Best.
Thank you. I'll be brief. The report states that together the post would enable the unit to deliver the Mayor's key manifesto commitments, including London Borough of Culture, Creative Enterprise Zones, the Thames Estuary Production Corridor, and the Commission for Diversity in the Public Realm. So how will that be measured?
Well, the delivery of those programmes will continue to be measured in the way that we measure them at the moment through the performance reporting regime and the dashboards that we provide to the Assembly on a quarterly basis. I think one of the challenges in delivering that has been a degree of instability within the team, and some of the coming back to the questions of fairness that we've discussed recently, some concerns around the fairness of that have been within the team, and this is an opportunity to get them to put members of the team who have for the most part been part of it for some time but on rolling fixed term contracts onto a more stable basis, and we hope that will support the delivery of those programmes so we can achieve the targets that have been set out through that performance reporting regime.
So why have the fixed term posts been so high within the unit?
I think because for some time, and I think to a certain extent this predates my arrival at the GLA, there has been a certain amount of change within the Culture and Creative Industries unit, and a number of the programmes that are now sort of established as either long-term or in some cases effectively permanent were originally set up as short-term time-limited programmes. So posts were set up as fixed-term to begin with. As the programmes were extended, the posts were either extended themselves or the issues weren't addressed, and now this is an opportunity to put that right and address the fact that we have programmes either like Culture and Community Spaces at Risk, which we see no reason, it seems unlikely is going to cease to be a priority given the challenges facing the sector, or like London Borough of Culture and Creative Enterprise Zones that began with a single round but now have been extended more than once.
Okay, thank you.
We'll bring in Assembly Member Best here.
Thanks very much, Chair. I just wanted to focus on the bits around the culture and community spaces.
Yes.
In 3.12 of the report, the last line of that sentence says, the levelling up agenda will see up to £70 million of funding leave London by 2025. Can you explain that statement?
There was a decision under the previous Prime Minister and the previous Culture Secretary when Arts Council grants were being agreed for the coming years to reallocate and reprioritise funding away from London-based institutions towards institutions in other parts of the country. And while one can understand the desire to provide greater certainty for arts institutions outside of London and the South East, the impact on that has been a degree of further instability within the London system. And although those grants were directly supporting the larger institutions in London for the most part, the impacts through the supply chain
So
go
can I
rather
just-
further down
I'm
through the
talking
sector.
specifically about £70 million, Phil. You said £70 million will leave London.
I think
that figure is incorrect. That's not accurate. It's less. It's much less. So actually, so what you'll find with that Arts Council grant is that the previous Secretary of State had managed to get £43.5 million extra funding from the Treasury for the Arts Council.
Okay.
And so what you've done is you've combined that amount with the potentially the amount that would be redistributed, which would be £24 million. And that's taken into account that London at the moment receives, say, £21 of Arts Council funding compared to, say, East Midlands, which gets £4. And I think in some districts it's even less. So there's still something we can talk about, but actually the figure that you've put in your report is completely inaccurate, and I think that that's something that should be taken out, and I think more care should be taken in putting these reports together.
Okay, I will go back and I will double check that figure. Thank you.
Thank you. And moving on, I think the other thing around the culture and creative unit, and I want to know in relation to the changes, in recent years, sorry, in recent years, the number of nightclub venues has fallen year on year on year. LGBT clubs, which are obviously a space that we'd like to protect, they've fallen year on year on year, and it's now lower than it's ever been. And we've seen 20% of the capital's business bouncers leave the industry because of this nighttime epidemic in London. The newest thing is people say you can barely find a pasty after hours in Leicester Square, let alone a party. How on earth are you going to tackle this recent trend of the nighttime crisis in London that we've seen over the past few years?
We're working through the Mayor's Night Czar and through the 24-hour London programme in a number of ways to try and address this crisis. We are supporting nighttime enterprise zones, which are supporting nighttime activity on a number of high streets across the capital. We recently announced some additional funding for that programme, and that is going to both directly support those high streets but also provide case studies that can be moved out more widely. We work directly with boroughs around licensing and regulation to make it easier for nighttime venues to operate effectively without causing unnecessary, with a balanced approach that doesn't cause unnecessary problems for residents. We are working with boroughs to help them put together nighttime strategies for the same reason. And alongside that, obviously, we have been through our Let's Do London programme and our Love London campaign supporting the return of tourism to the capital, supporting the activation of the centre of London, which brings people back in, which provides audiences and clientele for those venues. But they have been hit very, very, there is no sector that was hit harder by COVID. That changed a lot in terms of the immediate effect, in terms of the ability for many of those venues to survive. It has also changed the pattern of work, the pattern of travel, the pattern of how people socialise in London, and we are seeking to ensure that there are opportunities to make London as attractive a place to come as possible to address that. But it has been a really difficult turning of the tide, and it is going to be hard work to get it back to where it was.
Okay, so actually a lot of these issues predate COVID with the nighttime crisis within London, so I think it's unfair to attribute it to that because we have to recognise the wider scale of the problem. But the thing I'm most interested in looking at these changes today, say when we're back here a year and we're talking about the success of these changes and how this team works, will you be able to say that there is more nighttime venues in London, that the nighttime industry in London is rebuilt? Will we be looking at better figures than I presented you today?
I can't promise that we're going to be in a position to say there are more venues and that the nighttime sector has been rebuilt because of the headwinds that we're facing. You're absolutely right. Those aren't entirely due to COVID, but COVID was a big factor. We have been successful in securing both through our community spaces, our cultural spaces at risk, and through the work that the Night Czar has done, through the agent of change policies in the London Plan, at preventing the closure and supporting the reopening of a number of venues, the 100 Club, the Joiners Arms, and so on. It is hard work. We want to get it back to where it was before. But, you know, you're facing a lot of challenge in that regard, and I'm certainly not going to promise that or guarantee that we will be at a point where we're higher than we were before, though I'm confident we will be at the very least mitigating the impact of those headwinds.
I think that's really disappointing, to be honest, and well, I think we should expect more from London, but perhaps if we took more of the lessons from someone like Sacha Lord in Manchester, the unpaid night czar, who's actually done brilliant things for Manchester. Perhaps if we learnt some of those lessons within London, we could rebuild our nighttime economy. But that's all from me, Chair. But I do think that we should strike out that bit of the report that's inaccurate.
Thank you. I think Phil's agreed to take that back and have a look at that in terms of accuracy. And I've just seen Assemblymember Russell would like to come in as well.
Yes, I just wanted to briefly come in because this report is asking us to kind of to look at the changes to the GLA establishment, and there are particular staffing changes. And I do note that there are 2 culture and community spaces at risk officer posts, which will be directly engaged in working on the issues that Assemblymember Best has quite rightly raised about the problems in the nighttime economy. And many of these other jobs are that we're looking at here in this paper are absolutely about supporting that grassroots level cultural activity in our city. So I kind of think there's probably more agreement than disagreement about all of this. Thank you.
I'm not seeing anyone else wanting to come in on this item. Can I just see if the committee is minded to accept the proposals and support the proposed changes in this paper? I think that's agreed. Okay, thank you. I'm going to move on to item number 11, which is a food board update report, changes to the GLA establishment. And this was meant to be an update from a year ago when we made some changes to the food team. Unfortunately, I have suggested in the pre-meeting and also drawn Mary Hartley's attention to the fact that there are some potential issues concerning this report, and I think we've all agreed that more work needs to be done on the report, and we're going to withdraw this item from this agenda. Is that agreed? Thank you. The next item... Sorry, I'm withdrawing it from this agenda, but it will come back to a subsequent agenda for sure. Absolutely. It's not being completely withdrawn, no. The next item is number 12, which is the draft annual governance statement, which is on pages 149 to 150. Can I just see if the committee is minded to accept this? Okay, thank you. The next item is item 13, which is the GLA Oversight Committee work programme, our very own work programme. Can we note the committee's work programme for 22-23? Thank you. The date of the next meeting is going to be on Thursday, the 9th of November, in this very place at 10 a.m. There's no other business that I consider to be urgent, so I declare this meeting closed.